Hi, Barbara Friedberg here, meeting with Victor Haghani, founder of Elm Wealth and the newly launched Elm Dynamic Indexing ETF. And we're going to be talking about where the markets are headed. So buckle up and get ready for the ride. We are interviewing now in April 2025. The markets are insane. And according to fundamental valuations, price earnings ratio, or the earnings over price, the US stock market is very, very overvalued. And research by GMO, which is a well regarded value investing house, 7-year, puts the US stock market at really low negative digits annualized over the next 7 years. Now, neither you nor I nor anyone else knows where the stock market is going. So we'll preface that. But now that we've said that, what do you think? What do you think is going to happen with the US market over the next, say, 5 years, 10 years?
Well, over the next, say, 10 years, we think that the cyclically adjusted earnings yield of the stock market is a pretty good measure for trying to make an estimate of returns. And right now, the US stock market has a 3.5% earnings yield. So it's like you're buying a building for $100 and the rental income is $3.50. That's what the US stock market looks like right now. Now, if you believe that your rents will just grow with inflation, forever, then you would expect that that investment is going to give you a 3.5% real return adjusted for inflation. And, that is more or less what we think for the U.S. Stock market, 3.5% or so, annual expected long-term return above inflation. That's relatively on the low side versus history. It's not a lot of return, but the important thing is to compare it to your alternative. And the alternative, what can you get a safe return after inflation on? Well, the safest thing, it's not perfectly safe, but the safest thing that gives you a real return is a US government bond that's protected against inflation. They're called TIPS. And 10-year TIPS right now are yielding just over 2%. So that's saying that US equities are offering an extra 1.5% return relative to US TIPS. Well, that's not great. Like maybe if TIPS were trading at a zero yield or a minus 1% yield as they were, in 2021, for instance, then you would say, oh, well, US equities are offering an extra 4 or 5% relative to what I can get on government bonds. Oh, that's not bad. I like that. But now it's just 1.5%. That's what we think. But not only do we think that, you mentioned GMO. Let's put GMO to the side. GMO is saying US equities are going to have whatever minus 3 or 5. I don't know what their number is.
It's
Minus
like probably two-ish,
minus
I think, on
2%.
their
Okay, so
7-year forecast.
GMO is saying minus 2% for the next 7 years. They're quite an outlier. But if we look at that all of the big investment houses publish what they call their capital market assumptions. You can go on the internet, type in Vanguard capital market assumptions, BlackRock capital market assumptions, and we can see what all of these different houses are predicting for the next 10 years for the US stock market. I said 3.5% real return above inflation. And it turns out that that is pretty close to the average of about 15 places that we looked at their numbers on the web, from the ones I mentioned, to Morgan Stanley, J.P. Morgan, PIMCO, Invesco, a whole bunch of them, Northern Trust. We average them all together, and they're right around there. So, now of course GMO is lower. There's some people that are higher, but if you sort of just take the average of everybody and take lots of people, you come to something like that. And I think there is this consensus out there that U.S. equities on a long-term basis, don't have a high expected return over the next 10 years. In order for them to have a really high return over the next 10 years, only two things, there's only two ways for that to happen, right? Either earnings have to grow a lot and the PE stays the same, or the earnings don't have to grow that much, but the PE has to go up, the multiple has to expand, or a combination of those two things. So, it's possible. I mean, there's no reason, that we have seen PEs higher in Japan. The cyclically adjusted PE in Japan I believe it got close to 100 in the late 80s before the market there collapsed. So there's nothing magical about today's PE for US equities or cyclically adjusted PE. There's no reason it can't go higher. It could. Then then they would even have to go higher to get a really good return from there. Or, we'd have to see some really strong earnings growth, and maybe that's going to happen. It hasn't happened yet, but maybe, large language models or maybe the government policy. I don't know what could happen that could make earnings be a lot higher, maybe a very pro-business environment. You could see much higher earnings in the US, but history tells us that's not super likely. So we could get higher returns than the 3.5% real, but that's a reasonable expectation. And by the way, it's quite easy for the returns to be a lot lower than that too. That's why it's sort of a centering point. There's no reason that we couldn't see 6% real returns over the next 10 years, or we could see, 1% or zero over the next 10 years too. But it's not a lot of extra return above tips for the risk that people are taking. And that's one of the reasons that we're very underweight US equities right now.
Well, thank you for your prediction. And although it's not super high, I agree that most of the people that are looking at the future returns of stocks are pretty much warning everyone you're not going to see the returns going forward that you saw in the past. And so I just throw that out there. If you're investing today, just be prepared. So, Victor, wonderful chatting. We will see you again.
Thank you,
Bye.
Barbara. Thank you very much.
Thanks so much for watching today. If you like this video, please give us a thumbs up and subscribe. And if you do click on a link marked affiliate, our company might get a small commission to help fund this channel. See you next time. Bye.